If you're watching this, chances are you've worked incredibly hard to build your wealth. You've navigated career ladders, moved across continents, and saved diligently. But right now, there is a silent force working against your portfolio. One that doesn't make headlines like a market crash, but erodes your wealth just as effectively. Hello, everyone. Welcome to EPK Capital. Here we simplify wealth management and investments so you can build wealth for generations. As a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Let's get started now. I'm talking about interest rates. Most investors think of interest rates as something that just affects their mortgage payment. But if you are a high net worth individual, especially an NRI, interest rates are the gravitational force of your entire financial universe. When rates rise, the rules of the game change. Strategies that doubled your money in 2020 or 2021 can actually wipe out your capital today. Hi, I'm Kunal from EPK Capital. We build wealth for generations. For over 20 years, I've helped families manage substantial portfolios across India and global markets. Today, I'm going to strip away the jargon and tell you exactly how rising rates impact your money, the specific double whammy trap most NRIs fall into, and how you can pivot your strategy to not just survive but thrive. Let's simplify this. Warren Buffett once described interest rates as financial gravity. When rates are low, like they were for the last decade, gravity is weak. Asset prices, like stocks, real estate, and even crypto, can float higher and higher. It doesn't matter if a company is making money today. Investors will pay for the promise of money 10 years from now. But when interest rates rise, gravity gets stronger. Suddenly, that future promise is worth a lot less today. Why? Because now you have a safe alternative. If you can get a guaranteed 5% or 7% return from a risk-free bond, why would you risk your money in a volatile stock unless it's offering massive returns? This causes a repricing. And here is the first place HNIs get hurt. If your portfolio is heavy on growth stocks, tech companies, startups, companies that promise profits tomorrow but burn cash today, rising rates hit you the hardest. We saw this in 2022, and we see it every time central banks tighten liquidity. However, companies that are printing cash today, what we call value or quality stocks, they tend to hold up much better. Now, if you are an NRI living in the US, Dubai, or London, you have a second problem. I call this the NRI Double Whammy. And honestly, this is where I see 90% of self-managed portfolios failing to meet expectations. When the US Federal Reserve raises interest rates, the US dollar gets stronger. Global capital flows out of emerging markets like India and back into the US, chasing those safe, high yields. This puts pressure on the Indian rupee. Let's do the math on a napkin. Imagine you invested in a great Indian mutual fund. It gave you a 12% return this year. Fantastic, right? That beats the S&P 500. But because US rates rose, the rupee depreciated by 5% against the dollar. Your real return in the currency you live and spend in is only 7%. Is 7% worth the risk of investing in an emerging market equity fund? Maybe not, when you could have gotten nearly that much in a safe US bond with zero volatility. Ignoring this currency friction is the single biggest mistake I see. You cannot look at your India portfolio in isolation. You have to look at it in dollar terms. So, in this high rate environment, what are the mistakes you need to stop making today? Mistake number 1, the rearview mirror. Many investors are still buying what worked 5 years ago. Tech stocks always go up, right? Wrong. In a high rate world, cash flow is king. If you are buying hype instead of earnings, you are fighting gravity. Mistake number 2, the real estate anchor. I love real estate, but many NRIs buy property in India out of emotion. In a high interest world, rental yields in India are often 2% or 3%. If inflation is 6% and your loan interest is 9%, you are bleeding money every month. Don't trap your liquidity in assets that don't pay you. Mistake number 3, the cash coma. This is the opposite problem. Some people get scared and sit on 100% cash. But remember, inflation is also high. If your cash is sitting in a savings account earning 0%, you are losing purchasing power every single day. So, how do we fix this? At EPK Capital, we handle this for our clients by following three principles during high rate cycles. 1. Pivot to quality. We move capital into companies with low debt and high cash flow. These companies don't need to borrow money at expensive rates to survive. They are self sustaining. They act as a fortress for your wealth. 2. Lock in yields. When rates are high, bonds are beautiful. We help clients lock in these higher yields for the next 5 to 10 years. It provides a steady income stream that stabilizes the volatility of your stock portfolio. 3. Diversify currency risk. Don't bet everything on the rupee. And don't bet everything on the dollar. A true generational wealth portfolio has exposure to both, balancing the growth of India with the stability of the US. Investing when interest rates are rising isn't about guessing the market bottom. It's about risk management. It's about ensuring that your wealth continues to compound regardless of what the Federal Reserve does next month. If you are holding a significant amount of cash, or if your portfolio has been stagnant and you're not sure if you're positioned correctly for this economic cycle, let's have a conversation. I'm not here to sell you a product. I'm here to offer a perspective. You can find the link in the description to book a discovery call with my team at EPK Capital. We'll look at your current allocation and simply tell you if you are safe or if you are exposed. I'm Kunal. At EPK Capital, we build wealth for generations. Thanks for watching.